The Japanese yen is weakening once again, crossing above the 156 mark against the dollar. At the same time, we're witnessing a historic plunge in the 10-year JGB yield, dropping 16 basis points. In this video, we'll explore how the Bank of Japan's passive stance is igniting a renewed carry trade, and what the critical 162 yen level signifies for the global market. So, why is this happening now? Despite mounting global pressures, the Bank of Japan remains passive. This lack of decisive action is creating a dangerous divergence. Traditionally, Japan's debt has been internally held, but as the rate gap with the US widens, the yen carry trade is intensifying. The market is pushing the BOJ to its limits, revealing strains in its policy framework. The numbers are startling. The 10-year JGB yield has plunged to 2.71%, marking a staggering 16 basis point drop, the largest single-day decline since April 2025. This volatility underscores the deep uncertainty surrounding the BOJ's next steps. Meanwhile, US dollar to Japanese yen has surged back above 156. Traders are closely monitoring these figures, as a rise in yields alongside a falling yen signals a potential loss of control over both the currency and bond markets. On social media, traders are expressing growing concern. Many point out the BOJ's lack of decisive action, with a common sentiment emerging: something in the policy framework will eventually break if this trend continues. Market participants are frustrated, as the yen's weakness exerts immense pressure on other Asian currencies, making the carry trade increasingly attractive. Warnings from experts are becoming increasingly urgent. Former BOJ official Seiji Adachi cautions that if 10-year yields exceed the 3% threshold, it could seriously jeopardize Japan's fiscal sustainability. The government views the 3% to 3.5% range as a crucial line of defense. This policy put represents the limit of what Japan's economy can endure before the costs of servicing debt spiral into a national crisis. The equity market is caught in a precarious situation. While a weak yen typically benefits exporters, the bond yield volatility presents a significant headwind for the Nikkei 225. With the BOJ holding nearly half of all JGBs, any sudden spike in rates could destabilize Japanese stocks. Investors are carefully weighing the advantages of a cheap yen against the looming risks of a bond market collapse. Currently, the Ministry of Finance is attempting to manage US dollar to Japanese yen around the 162 level through verbal interventions. This scenario presents a classic clash between market forces and government warnings. Traders are gauging these MOF threats against a softening US dollar. However, with the BOJ maintaining its passive stance, the risk of breaking through the 162 level remains high, potentially prompting direct foreign exchange interventions by Japanese authorities. For individual investors, it's crucial to focus on yield thresholds. The 3% mark on the 10-year JGB is the key indicator. If yields surpass this level, expect significant volatility in the yen and possible policy shifts. Now is not the time for over-leveraged positions in carry trades, especially since the government's verbal intervention at the 162 level indicates readiness to act if depreciation becomes too rapid or chaotic. Now, let's explore the AI scenario analysis. In the base case, the yen remains weak between 156 and 160 as the BOJ continues its passive approach. In the bearish scenario, reaching the 162 level triggers significant MOF intervention, while JGB yields could spike toward 3%, raising questions about Japan's fiscal sustainability. In the bullish scenario, the BOJ finally takes decisive action with a surprise rate hike, stabilizing the currency back toward 150. To recap, the yen is hovering at 156, JGB yields are in turmoil, and the 162 level stands as the Ministry of Finance's line in the sand. Keep a vigilant eye on the 3% yield threshold. What do you think the BOJ's next move will be? Share your thoughts in the comments below, and don't forget to like and subscribe for more in-depth explorations of the Japanese economy. See you in the next video.